Hey e-builders and entrepreneurs, welcome back to another episode of Entrepreneur's Corner with your host, Mr. P. So today we're going to talk about a very important topic when it comes to money. Yep, you heard it right. Today we're going to talk about money and the three financial pillars. But before we get started, you got to understand there's many ways of making sure that you keep track of how your business is doing. And these three financial pillars are the essential metrics to make sure that you're on track. What are those pillars? Well, it's cash flow, revenue, and profit. So let's jump into it. Revenue is just the money that comes into the business. For example, say you sell a whole box of cookies for $10. Well, that's $10 in revenue. But hold on, that doesn't make you richer yet, because there's more to it than that. Because those cookies just didn't come out of nowhere. You had to basically spend money on materials to make the cookies, which goes into profit. So your profit is the money you have left after you account for the money you had to spend to make those cookies. Now, it's really important to keep this in mind because profit is basically how you price your product so that you can stay in business. So pricing your product depends on how much money you want to keep in your pocket. But I recommend that you invest it back in the business so you can make even more money in the future. So when it comes to profit and calculating it, you got to consider your costs. So since profit is your revenue minus cost, let's talk a little bit about that. Not all costs are made the same. You have what we call variable costs and you got fixed costs. A variable cost will be a cost that changes depending on how much you produce, like the materials you use to make your cookies. Sugar, chocolate chips, sprinkles, the dough, you get it. Those things go into the materials or the materials to make your cookies. Also, what about hiring people to help you make more cookies? So those are all examples of variable costs. Now, fixed costs would be the opposite. They're things that cost the same regardless of how much you're producing. Say, for instance, you make one cookie or 10,000 cookies. To store those cookies, you would have to pay rent. So no matter how many cookies you got, the rent price would always be the same. That's an example of a fixed cost. So there's other things that play an important role here too. Sometimes you get cost advantages that you could produce a bigger batch of cookies and then make more money, but we'll talk about that in a future video. And then we got the third pillar and the final one, cash flow. Now cash flow is a really cool metric you want to keep your eye on. See, cash flow basically is all the money that's coming in and going out of your business. So if you sold that box of cookies for $10 in your bank account, that counts as cash flow. If you had to pay $1 for the box that you put the cookies in, well, that counts, part of cash flow. What if you pay somebody to help you bake the cookies? That also counts as cash flow. But keeping track of the money coming in and coming out is very important because it gives you a bigger picture of the current state of your company or business. Let's break down cash flow into three main activities. The first one is operating activities. The cash from operating activities is pretty much the same as your profit. So the money that comes in from sales after you take it into account costs such as materials and employees and interest and taxes from debt, those are operating activities. We won't dive much into this already since we talked about profit, but just keep that in mind. You want your cash from operating activities to grow over time. If it shrinks, your company will probably go bankrupt at some point. Then you got the second activity, investing activities. Cash from investing activities is money you spend on long-term things that will help you grow your business. Say, for example, you've been baking your cookies on a small oven and you're selling them and making a profit. That's cool, but you only can make 200 cookies a day in this oven. So you decide to invest in a larger industrial oven that would allow you to make 2,000 cookies a day. Now you'll be able to sell more cookies, so buying this oven will help your business grow. This money spent on the oven is cash from investing activities, but it will appear as a negative number because it's money that came out of your company's account. But that doesn't mean it's a bad thing because it's something that will help you recover that investment and make more money down the line. And the final activity is financing activities. So cash from financing activities is basically the money you've gotten through things like a loan. So let's say you know your sales drop every September, but you know that you will make that money up in October because you always have a good month in October. So you decide to take a loan to help pay the rent and other expenses until you get to October. That will be considered financing activity. But here's a little secret. You don't want to take a term loan when you're trying to finance activities because, for example, say for instance, you know that September's are slow months and you borrow $100 to make up for the slow activity in the business. But then say October comes and it doesn't perform the way you want it to perform. Say for instance, you actually lose $200. So you spent that $100 in that term loan in September and now you got a bill to pay and then October's slow. So as a tip from Mr. P, and something I've learned is you never want to finance activities using a term loan. You only want to use a line of credit. Now, when should you use a term loan? Best time to use a term loan is if you have a fixed asset. So an example of a fixed asset is the oven, right? Because the oven basically is going to perform the same function every single day, every single week, every single month. It's not going to change. It's not going to be variable. So just a little tip for you e-builders out there that's got some big things going on. So it's very important to keep in mind, even though this appears as a positive number because money's entering your account from a loan, that this money you will eventually have to pay back. So you got to be really careful about what you finance. That's why I gave you an example of a term loan versus a line of credit, because these decisions will make sense so you pay back later and don't end up eating your business in debt. As you can see, there's a lot that goes on in cash flow, and the numbers you get in each of these activities can paint a very different picture about how your business is doing. I mean, a company with $100,000 in operating activities is probably doing better than a company with the same $100,000 in financial activities, even if they have the same $100,000 in the bank, right? So we talked about a lot today: cash flow, revenue, and profit, and the difference between them and the different components. So if you love videos like this, you may want to consider subscribing to my channel, because Mr. P gonna be dropping some jewels. But anyway, thanks for tuning in. I'll see you guys next time. Later.